Imagine this for a moment. You are 72 years old. You are sitting at your kitchen table with a stack of tax papers in front of you. Your eyes are tired. Your back hurts from sitting too long. And there, in your hands, is a letter from the IRS saying you owe $10,000 in penalties. Why? Because you missed something. A rule, a deadline, a form you didn't even know existed. You had no idea. Nobody told you. And now your life savings, the money you spent 50 years building, is shrinking right before your eyes. Your hands begin to shake. Your mouth goes dry. You whisper to yourself, "How is this possible? I followed all the rules I knew about." If that fear feels real to you right now, please don't go anywhere. Stay with me. Because the truth is, the IRS gives retirees 7 powerful tools after age 70 that most seniors never use. Tools that can save you tens of thousands of dollars. Tools that can lower your taxes, protect your Social Security, reduce your Medicare premiums, and pass more wealth to the people you love. I am Masha. I am a senior policy analyst, and I help retirees just like you understand the complicated rules that quietly drain retirement savings. Today, on Pension and Law Unlocked, I am going to walk you through the 7 things the IRS lets you do after age 70 and a half. Things your tax preparer may not have told you. Things your bank certainly won't mention. Things that could change your retirement starting today. And please, stay until the very end. Because there is one mistake I see retirees make again and again that costs them up to $10,000 in IRS penalties, completely by accident. I do not want that to happen to you. Let me tell you about Harold. Harold is 74 years old. He lives in a quiet suburb in Pennsylvania. He worked as an accountant for 41 years. He has a paid-off home, a traditional IRA worth $480,000 and a small pension. And he always considered himself careful with money. But Harold made several mistakes that cost him dearly. First, he believed his required minimum distribution had to start at age 70 and a half. That rule changed years ago, but nobody told him. He took distributions he didn't need to take, raising his taxable income for 3 years and pushing him into a higher Medicare premium bracket. Second, Harold gave $15,000 to his church every year. He took the money out of his IRA, paid taxes on it, then wrote a check to the church. He had no idea that if he had transferred that money directly from his IRA to his church, it would not have counted as taxable income at all. Third, in 2024, he simply forgot to take his required minimum distribution by December 31st. He was busy caring for his wife after her surgery. The IRS hit him with a 25% excise tax on the missed amount. Total cost of these mistakes? Just over $14,000 in unnecessary taxes and penalties. Harold sat in his recliner, holding the IRS notice, and said quietly, "If only I had known." I am telling you, right now. So please listen carefully. Here are the 7 things the IRS lets you do after age 70 and a half that most retirees never use. Number 1. The Qualified Charitable Distribution, or QCD. This is one of the most powerful tools in the entire tax code, and almost nobody uses it. According to IRS publication 590B, if you are 70 and a half or older, you can transfer up to $108,000 in 2025 and $115,000 in 2026, directly from your traditional IRA to a qualified public charity. Here is why this matters. The money never touches your hands. It never shows up on your tax return as income. It does not raise your adjusted gross income. It does not increase the taxable portion of your Social Security. And it does not push up your Medicare Part B and Part D premiums through IRMAA. If you are already donating to your church, your synagogue, or any other qualified charity, you should almost always do it through a QCD instead of writing a personal check. Number 2. Required minimum distributions. Now begin at age 73, not 70 and a half. This is critical. The Secure Act of 2019 and Secure Act 2.0 of 2022 changed the rules. RMDs from your traditional IRA, your 401k, and most workplace retirement plans now start at age 73. And in 2033, that age moves up to 75. Why does this matter? Because every year you can legally delay taking distributions, your money continues to grow tax-deferred. If you have been taking RMDs since 70 and a half out of habit, you may have given up years of growth you didn't need to give up. And one more thing. Roth IRAs have no required minimum distributions during your lifetime. Ever. None. Number 3. The still working exception. Here is something almost nobody knows. If you continue working past age 73 and you are not a 5% owner of the company, the IRS lets you delay RMDs from your current employer's 401k until April 1st of the year after you retire. So if you are 75 and still working part-time at your old company, you may not need to take RMDs from that 401k at all. But this exception does not apply to traditional IRAs, SEP IRAs, simple IRAs, or 401k plans from former employers. Those still require RMDs at age 73. Number 4. There is no age limit on IRA contributions. For decades, the law said you had to stop contributing to a traditional IRA at age 70 and a half. That law was repealed in 2020. As long as you or your spouse has earned income from work, you can keep contributing to a traditional or Roth IRA at any age. In 2025, you can contribute $7,000 plus a $1,000 catch-up if you are 50 or older. That's $8,000 per qualifying person. And here is something powerful. Even if you don't work but your spouse still does, your spouse can contribute on your behalf through a spousal IRA. Number 5. The new $6,000 Enhanced Senior Deduction. This is brand new and many tax preparers haven't even mentioned it. Under the One Big Beautiful Bill Act, signed into law on July 4, 2025, IRS Publication 554 confirms that for tax years 2025 through 2028, taxpayers age 65 and older can claim an enhanced senior deduction of up to $6,000 per qualifying senior. That's $12,000 for a married couple where both spouses are 65 or older. The best part? You can claim it whether you take the standard deduction or itemize. The deduction phases out at higher incomes, but for most middle-class retirees, this is free money on the table. If you are not claiming this deduction, you are silently overpaying the IRS. A single senior in the 22% tax bracket loses up to $1,320 a year. A couple loses up to $2,640. Over 4 years, that's more than $10,000 quietly lost. Number 6. Roth conversions with no age limit. There is no upper age limit on converting traditional IRA money to a Roth IRA. None. You can do it at 72, at 80, at 90. Why would you want to? Because once the money is in the Roth, it grows tax-free forever. All withdrawals are tax-free, and the Roth has no required minimum distributions during your lifetime. This means more wealth to leave to your children, your grandchildren, or your favorite cause. But please, listen carefully. If you're already age 73 or older, you must take your full RMD first before doing any Roth conversion. If you mix them up, the IRS treats it as an excess contribution and hits you with a 6% excise tax every year until corrected. Number 7. The 7.5% medical expense deduction. According to IRS Publication 502, if you itemize on Schedule A, you can deduct medical and dental expenses that exceed 7.5% of your adjusted gross income. For seniors, this often includes Medicare Part B premiums, Medicare Part D premiums, Medigap premiums, Medicare Advantage premiums, long-term care insurance, prescription drugs, eyeglasses, hearing aids, dental work, transportation to medical appointments, and even certain home modifications for medical reasons. Most retirees never track these expenses. They miss the deduction completely. If you have significant medical costs, this single deduction can save you thousands. Now please pay close attention, because here is the hidden mistake I promised to share with you. It is the missed RMD. According to the IRS, if you fail to take a required minimum distribution by December 31st of the year it is due, you face a 25% excise tax on the amount you should have withdrawn. On a $40,000 RMD, that's a $10,000 penalty, gone in an instant. But there is a way to fix it. Form 5329. If you correct the missed RMD within 2 years, the penalty drops to 10%. And if you write a reasonable cause letter explaining what happened, like a serious illness or a death in the family, the IRS often waives the penalty entirely. But you must file the form. You must ask. The IRS will not do it for you. Now let me give you 3 exact actions to take. Right now. This week. Step 1. Open a My Social Security account at ssa.gov/My Account. Then verify your retirement account information at IRS.gov. Know exactly what your required minimum distribution is for this year, when it is due, and which accounts it applies to. Mark the December 31st deadline on your calendar in red ink. Step 2. If you give to charity, talk to your IRA custodian today about setting up a qualified charitable distribution. Do not take the money out first and then donate. The transfer must go directly from your IRA to the charity. This single change can lower your taxes, protect your Social Security from extra taxation, and reduce your Medicare premiums. Step 3. Before your next tax return, ask your tax preparer 3 specific questions. Are you claiming the new $6,000 Enhanced Senior Deduction? Are you using Form 1040-SR? And are you tracking my Medicare premiums and other medical expenses for the 7.5% deduction? If your preparer cannot answer clearly, find a new one. Or visit a free AARP Foundation tax aid site where volunteers are specifically trained on senior tax issues. Now please listen to me carefully. Everything I have shared with you today comes directly from IRS publications 502, 554, 590A, and 590B, from the Social Security Administration, and from official IRS retirement plan FAQs. These are not opinions. These are the actual laws and rules that govern your retirement. But here is the painful truth. The IRS will not call you to remind you. The Social Security Administration will not warn you when you are about to miss an opportunity. Your bank, your broker, your insurance company, none of them will tell you about these 7 tools. You have to know about them yourself. And you cannot rely only on YouTube notifications. The algorithm changes constantly. Important videos that could save you thousands may never reach your screen, so please do this for me. And more importantly, do it for yourself. Bookmark the official IRS website at irs.gov. Bookmark ssa.gov. Bookmark medicare.gov. Visit arp.org for free senior-specific tax help. Check these sources at least once every tax season. Share this video with someone you love, a spouse, a sibling, a friend at church, a neighbor who just turned 70, because the family that knows the rules keeps their money, and the family that doesn't loses it to penalties they never saw coming. Subscribe to Pension and Law Unlocked, hit the notification bell, and stay with me. Because next week, I am going to reveal another quiet rule that affects every retiree in America. You work too hard, for too long, to leave money on the table. Stay informed, stay protected, and I will see you in the next one. This is Masha. Take care of yourself and take care of each other.